Hey, welcome back, folks. Happy New Year. We hope the holidays treated you well. In this video, we want to give just a 2025 outlook. My name is Tony Christensen. I'm a CFP.
My name is David Harris. I'm a chartered financial consultant.
And so today in this video, we're going to cover the following items. So what happened in 2024? What are some of the things that we saw that worked out well? What are some of the things that didn't work so well? And then what we're also going to then go into is just what are some of the potential outcomes in 2025? We want to throw in there, what are some of the threats and the opportunities that we may be needing to be looking for? And then lastly, what does this all mean to you, your investments, and your plan? So let's get right into it. As a quick recap, if you had money invested in the markets, it was probably a really good year, depending on what you were invested in. So the S&P 500 returned roughly 23%. The Dow returned roughly 13%. The NASDAQ was up roughly 28%. Another positive that came from last year is the year-end reading of year-over-year inflation was at 2.7%. Now, as a reminder, the Fed's target and the thing that they've been talking about over and over again is they want to get it down to 2%. So we're making progress, and that's also where these Fed rate cuts come in. We had 3 cuts in 2024. And then we have a lot of clients that ask us about what is crypto, how did it do? So Bitcoin, as an example, did 120% in 2024. So pretty crazy. So David, I want to ask you this question. As you look at the returns between the S&P 500, the Dow, and the NASDAQ, there's a decent discrepancy there. Walk us through what's the difference between those indexes?
Great question, Tony. Let's talk about the similarities and then let's talk about the differences. So the S&P 500 is essentially 500 large cap companies within the US that represent pretty much all sectors in the financial world. The Dow, on the other hand, does have a representation of many sectors. However, it's not nearly as broad as the S&P 500. And then the NASDAQ is almost all tech. And therefore, you will see that tech was the big winner last year. And so why was the S&P up 23%? Because 34% of the S&P was represented by the largest tech companies as well. The Dow has a far less concentration of tech companies, and that really was the big difference between all 3 of those indices.
Great, thank you. So let's move on to the not so positives. So as we look at 2024, we just talked about all the things that were pretty amazing. Let's talk about the things that weren't so amazing. So the aggregate bond index was actually down 1.2%. Now, the primary driver to that is we still have a very uncertain inflation and interest rate environment. And until that gets under wraps, the aggregate bond index will probably continue to struggle. Now, at the same time, the international stocks, they only went up by about 3.8% according to the EFI index. And one of the big drivers on that, folks, is you have a lot of tariffs that are being proposed. And so there's a lot of uncertainty for how a company operates with the United States internationally. And so it gets a little sticky, and hence they didn't do as well. And then lastly, we've got real estate, as just followed by a Vanguard real estate ETF, and they were only up 4.8%. Now, I think it's pretty easy to see why. We have interest rates that are really high, and real estate relies on leverage. It relies on the ability to borrow money and build things, and I'm sure you all can have had experiences with how rough interest rates are right now, whether for you or your kids, your grandkids. And so ultimately, these are some of the things that we dealt with in 2024 that weren't so positive. And so one of the questions that we want to pose, and I'll pose this to David. David, why would we even have any one of these in our portfolio? You know, we look back, it's easy to go backward and say, man, I wish we wouldn't have had any of this in the portfolio and just had the NASDAQ. But
Right.
That's not real.
Right.
So walk us through, why would we even have some of these things in there?
Great question, Tony. So if we look at the last 12, 13, 14 years, bonds really have not been a great performer, primarily because interest rates have been low. Now interest rates have risen. And with interest rates higher, with the potential to come lower, that would absolutely help, especially long-term bonds, to be a great investment moving forward. Now, when that happens, when interest rates come down, we don't know. But having that as a part of your portfolio can not only be a defensive position, but it also can be a stabilizer in the portfolio that if the market does come down and interest rates do come down, bonds will not only stabilize the portfolio, but you actually might get gains in your bonds, and not only on the underlying bond, but the coupons as well. So bonds could be a great place for some of your assets in 2025, or whenever interest rates actually start to come down. International. This is a simple case of we don't know exactly what's going to happen with tariffs. We don't know what's going to happen with a lot of things, but international over time has sometimes, again, done better than U.S. stocks, and U.S. stocks have sometimes done better with international. This is more of a story of just making sure that you have diversification within your portfolio, because when the U.S. market is down many times or not doing as well, sometimes the international market is doing very well. And real estate is what we would consider a non-correlated asset. It operates on slightly different rules than the stock market does. So you will see real estate provide sometimes income and stabilization to a portfolio. As these interest rates start to come down, real estate could also be a good winner over the next little while and create stabilization within a portfolio.
Great. So I think what David just mentioned is the very things that were not so positive in 2024 potentially could be a good thing in 2025. Now, no one knows, but if rates do come down, this should do fairly well, but it also should help bolster real estate because borrowing costs are lower. So we're just trying to keep an eye on all these moving pieces, and at the end of the day, diversification is a good thing, especially as you get into a different phase of life. So all these things are just important for you to kind of see it and understand how they may play into your portfolio. Now, some of the potential outcomes in 2025. Now, this one's kind of a funny thing for us. We do this every year. We look at what are the big banks and analyst firms, what are they predicting that the S&P 500 will do this coming year, so in 2025. Now, you will notice they're pretty high. Between 10 and 20% is what some of these guys are predicting approximately. So the question is, why do we even care what these guys say?
Great question. I'm not sure that we actually do. It's more important for us to know what you are hearing as consumers and as clients. Because in 2024, many of these same banks would have projected somewhere between a 0 and probably a high single-digit return, whereas the stock market ended up at significant double-digit returns. And so were they off? Yes. Almost every prediction was off significantly. And in many of the conferences that we went to and listened to many of the bank economists speak, many of them were negative and thought that the S&P would actually be negative in 2024. So I guess the main point that we want to point out here is that it's noise. And you cannot base how you will invest based upon these predictions for the next upcoming year.
And I think it just goes back to this idea of, your plan requires certain types of assumptions. And our biggest concern for our clients is that they try to make big decisions based on these projections. And that's just a dangerous game to play. So hence, we like to look at them. We look at them every year. And if you go out online and just compare, their projection versus the actual, it's kind of a fun little exercise. So let's talk about some of the threats in 2025. Now, we've already somewhat touched on them. Ultimately, we think our biggest threat is, once again, this inflation rising. So in 2025, we think the big story is going to be inflation again. We're going to be watching inflation. We're going to be watching the Fed. And ultimately, this could surprise us on either end. And depending on which way it goes, it affects everything. And so we are cautiously watching that, and we're hoping that we really are slowing inflation down. We really do have the potential for the Fed to cut again this year. That is our hope. Now, and we'll just continue to monitor that. Now, another concern that we're seeing is overall stock valuations are a little higher than the normal average for something called PE ratios. So just something on our minds that we're kind of cautiously watching. This third one is political uncertainty. And as you can imagine, there's just things you can't predict. We don't know what tariffs may come in. We don't know what policy shifts may take place. And we don't know exactly what that may or may not affect. So we're cautiously watching what that may look like as we move into 2025. And then this last one is something we just called the Mag 7 concentration. So I'm going to have David. David, tell us what this is and why it's a threat or a concern that we're watching.
That's a great question. The Mag 7 basically are the top tech companies. For example, again, You're talking about Tesla, you're talking about Nvidia, Google, Meta, Apple. These companies have become so large and so powerful, and they are leading the charge on the S&P 500 and the NASDAQ, and the whole world is watching these guys, and it's highly concentrated. That is always a concern, because one of the reasons we love the S&P is because it's diversified and it's spread between 500 different stocks. But if those 500 different stocks are really only led by 7 as a high concentration, for example, the S&P 500 returned 23%. The average S&P stock only returned 11.5. The average Magnificent 7 stock returned 63%. The winner of that was Nvidia, returning well over 100%, and that is a concern from a diversification standpoint. Are we really diversified when we look at the S&P 500?
So ultimately, we get this question all the time from clients. Hey, should I be buying, Apple or Nvidia or Microsoft? And what they don't know is that by being in the S&P 500 index, they have approximately 35% exposure to those 7 stocks already.
Exactly.
And so if you wanted more of that, you just have to recognize what you're getting, and that you might be getting a little lopsided. Just need to be cautious. You need to be aware of what you own and what's in an index. So it is a threat. Now, what you're going to find here, and I'm just going to jump to this middle one, it's also the opportunity, because it's those Mag 7 stocks. They're leading the charge in artificial intelligence. And this may be kind of that next big revolution in our overall economy. How is AI going to shape our world? I think a lot of us are still just unsure, but it is moving fast, so fast that we can't even keep up. So this could be a huge opportunity in 2025. Now, some of the other ones are, we're going to make the assumption that fixed rate investments, savings accounts, money market accounts, CDs, fixed rate annuities, we think all of those will continue to provide decent returns or decent rates, fixed rates in 2025. So that's a positive. And I think the biggest opportunity and that we're looking for is we just want to see rates stabilize, because that rate stabilization will have a wake that kind of filters into so many different asset classes that could be a real good bolster to a handful of different types of investments. So those are the big opportunities that we're looking at in 2025, and they kind of filter in different ways. Let's go to this. So we've covered some data, and ultimately, you might be sitting there watching this and you're saying, okay, that's great. Tony, David, thank you for that info. What does that mean to me? How does this apply in your world? And so I'm going to pose that question. David, as we just talked about a lot of data, the pros and cons of last year, what we could potentially see in 2025. What does it mean to us?
When we look at this, I think the number one thing that you can pull from data like this is my asset allocation in line? How is my overall economic world set up? And for people that are already retired and taking income, it's going to be different than for people that are still accumulating money. You're 5 years out from retirement, and you're trying to set up that situation. So if you have a plan, great. The point is, it may need slight adjustments, but stick with it. If you don't have a plan, well, that's where you may need to really think about what's going on, because when you have a plan, you have direction. It brings a level of peace. It helps you make better decisions on your investments. And as Tony said, one of the opportunities is, we've seen it, fixed rates are sitting still in a bank. You can get 3 to as high as 5% in some fixed rate annuities. And if you're not taking advantage of that in your foundation or your safe bucket, then you absolutely should be. And if you have income, great. But if you don't know how you're going to pull income into your plan through your portfolio or through your assets, that needs to absolutely be nailed down. And then the other big thing we talked about was inflation and rate stabilization. Well, with that being on the table, you need to have assets that are growing and outpacing inflation. As many people have talked about, if you're not, you're essentially going broke slowly. So the biggest takeaways I see is, 1, make sure you have a plan. 2, stick to that plan with the small adjustments. And then 3, if you don't have a plan, absolutely start. Start somewhere. If we can help you, great. If you want to just start on your own, great, but start with a plan.
Great advice, David. Thank you. Folks, to our friends, to our clients, thank you for your trust. Thank you for allowing us to be along the ride with you. We hope this video is helpful. as you kind of just recap on your own situation. If it has been, please share it with your family and friends. And as always, you're always welcome to subscribe to our channel just for more updates and more information that we hope is helpful. Once again, thank you so much, and cheers to an amazing 2025.
Thank you.